You are listening to Keystone Stock Talk Show, episode 176.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
The band is back together. The calendar has turned to September, and we are taking you back to school this week. In keeping with the back to school theme, Brennan will start by defining the rule of 40. And that's not referencing the idea that it all goes to crap after you hit 40, or his favorite movie, the 40-year-old version. The rule of it hits home. The rule of 40 is a commonly used metric when comparing SaaS companies and is a simple framework that balances revenue growth versus profit margins. Brett is going to take a quick look back and review one of our more popular stock versus stock battles of the past couple years, which pitted two hot at the time renewable energy companies, Greenlane Renewables, symbol GRN on the TSX, and Xebec Absorption, symbol XBC on the TSX, against one another. Greenlane won the battle at the time, but neither met our criteria. Brett will take a look at where they are both at today. I will hit the mailbag and take a quick look at one of the hotter TSX venture stocks this year, Patriot Battery Metals Inc., symbol PMET on the TSX Venture, which is seen its share price jump from the 55-cent range to just under $7. What is driving the gains, and is it sustainable? I'll let you know. Finally, in our Your Stock Our Take segment, Aaron reviews Nvidia, symbol NVDA on the NASDAQ, the world's top designer and manufacturer of GPUs, or graphic processing units. The tech giant has seen its share price slashed 60% from 2021 highs, and recently released ugly Q2 numbers that helped pour gasoline on the recent tire fire. Aaron lets you know his thoughts on the company's current valuations. So let's get into it. I'd like to welcome my co-hosts today, Aaron, Brett,
Gentlemen.
Brennan, the Killer Bees. How you doing?
Doing well.
Back to school for Brennan, right? You're going
yeah.
grade 7, 8?
Yeah.
Yeah,
grade 7.
Middle school, right?
Yep. Big school or big year. Parents drove me to school this morning. Yeah, it was good.
Nice.
My mom packed me my lunch. Colleen, she's a saint. I've said that many times. But yeah, that was funny. My favorite movie there.
Aaron, you got the kids off to school this morning?
Yeah, first day back at school. So my youngest is in kindergarten. That's a big move forward for the family. Got 2 kids now in elementary. One drop off, one pickup. So that'll be a nice little time saver. But so far so good.
For sure. Gradual re-entry, probably.
Gradual re-entry. So it'll be 6 months, about halfway through the year before it's full day kindergarten. But no, it's about 3 weeks. 3 weeks of that.
Yeah, my daughter, we got off today. She's in grade 2, which, I think it's crazy. It is way too fast. It's nuts. Yeah. But anyways, it's cool.
No doubt.
It's good. So everybody, all the parents out there, the rest of you guys like Brennan and Brett don't really matter. So
no, this is just gibberish.
No, it doesn't matter to them is what I'm really saying, right? So, but back to school is a crazy time, and we wish all the parents out there good luck, or maybe have some time to yourself for about 10 minutes during the day. So is there anything we want to talk about? We got like a really, packed show today. So maybe we should just get into,
we can get right into it. I mean, there weren't a lot of really important things that I thought that we needed to talk about on a macro level. There is a Bank of Canada meeting coming up. The expectation is that rates are going to go up probably.
Secret. on Bay and Wall Street, everybody just basically at the end of August, nobody's even anywhere. They're out at the
Essentially,
lowest
yeah.
volumes of the year. Everybody gets the hell out
It's
of
back to
Dodge.
school, but it's back to the
Yeah.
markets as well. So the last,
It is right
August
now.
is like dead time in the market. So
there'll be a lot more to talk about in terms of newsy items in the next podcast, but we've got a ton of actual individual companies and some educational. It's back to school. Brennan, you want to take us back to school to start and get to the rule of 40?
I would love to. Yes. So the rule of 40. I learned about the rule of 40 not too long ago. It was probably about 2 years ago. Yeah, it was Ryan, taught me it. And I thought that it would be good to kind of teach people what it is because I had no idea what it was at the time. So let's go back to school. So the rule of 40 is a commonly used metric when comparing SaaS companies or software as a service companies, and is a simple framework that balances revenue growth versus profit margins. And essentially, it's a rule of thumb to quickly determine the health or attractiveness of a SaaS company. So for a quick general example, if a theoretical company has 20% revenue growth and profit margins of 20%, we would add those two figures together and the company would have a rule of 40 score of 40%, meeting the threshold of the rule of 40. Now, essentially all we're doing here is just taking the revenue growth and the profit margin and getting our score. So if a score is above 40, it is considered a passing grade, while a score below 40 means that the company fails the rule of 40 test. But let's go a little bit deeper here. So for the revenue growth, you can either use recurring revenue growth or total revenue growth. If subscription revenue comprises most of the business's total revenue, we can generally just go ahead and utilize total revenue. And then for profit margin, it is common practice to use EBITDA margins or earnings before interest, tax, depreciation, and amortization. And the reason being is because EBITDA tries to place companies on a common playing field by stripping out interest from debt, differences in taxation, and accounting policies to approximate its operating cash flow. Now, generally speaking, there is a trade-off between revenue growth and high margins. For example, if a company has high revenue growth and low margins, it is likely because the business is investing heavily into sales and marketing, thus reducing margins. But of course, this is not always the case. But you can see there's a little bit of a balancing act that goes on between the two. So now that we know how it is, or what it is, and essentially how to calculate it, let's look at a real life example from a couple of companies rated as Monitor in our recent US SaaS software technology report, which was released to clients. So the two companies that I'm going to look at here is DigitalOcean Inc., DOCN, on the New York Stock Exchange. Essentially, this company operates a cloud computing platform that provides on-demand infrastructure and platform tools. Its solutions include website hosting, web and mobile apps, video streaming hosting, gaming development, and more. And I'm going to compare it with Palantir Technologies, PLTR, on the NASDAQ. Aaron's talked about this company a bit before, and it is a SaaS company that revolves around data collection and analysis. So I'm just going to quickly go over DigitalOcean and then Palantir. So this is all for the fiscal quarter Q2 of 2022. Technically, if we wanted to look at the year results or the 12 trailing month results, that would work perfectly, and it would actually smooth out any quarterly variations. But just for this, taking you guys back to school, I'm just going to look at the Q2 2022 results. So for DigitalOcean, revenue growth was 29%, and they have an EBITDA margin of 34% in the last quarter. So you just add those together, and we get a rule of 40 score of 63 or 63%. Palantir, on the other hand, has revenue growth of 26% and an EBITDA margin of 24%. Adding those two together, we get a rule of 40 score of 50 or 50%. So as we can see, both companies surpass the threshold of the rule of 40 with DigitalOcean's score of 63, while Palantir's score is 50. And based just off this one metric, DigitalOcean appears to be the more superior business. But of course, this is just one financial metric. We would look at much more than this to determine if a business is investable or not. But essentially, that is what the rule of 40 is for SaaS companies. And now you can consider yourself schooled.
Right. So Yeah, no, interesting way to look at a company. One other point that I'll make is that a lot of SaaS companies also aren't profitable. So the rule of 40 is even applied if you're looking at negative operating margins, right? So if say a company is losing money, they have an operating margin of negative 20%, then they would have to grow the revenue at a rate of 60% in order for them to pass the rule of 40. So it's, on one hand, essentially what you're doing is you're looking for companies that have a balance of strong revenue growth and strong margins, some type of a balance, either skewed towards one or the other. Now, I don't know how you would look at it if, say, the company had high operating margins but negative revenue growth. I mean, a company could still pass the rule of 40 under those circumstances. I don't think that's the point of the rule of 40. I think the point is that a lot of the times there's actually a negative operating margin on there, and the rule is trying to say that that's okay as long as the revenue growth more than compensates for that. But just a couple points that I'll also make. You had mentioned Palantir. We talked about Palantir on the last week's podcast. Specifically, we were looking at the company's stock-based compensation and how that impacted the financial reporting. So if you were to look at EBITDA, adjusted EBITDA, not considering stock-based compensation, yeah, you're probably getting that 24% margin. If you're to include stock-based compensation, you're actually looking at a negative margin. So that skews the picture. So that's one thing to keep in mind, that stock-based compensation can have a major impact there. Another thing is that saying rule of 40, it is really kind of arbitrary, just picking 40. Like, why is it 40? Why is it not the rule of 35 or the rule of 45 or
69,
50 or something else, right? But I think that, just as a general idea, looking for companies with high revenue growth, high margins, if they, on a combination, if they pass the rule of 40, there's nothing wrong with that.
And then where does the growth come from, right? Is it acquisition growth or organic growth, right? I mean, in our case, if you're doing 20% organic growth, it's typically better than 20% acquisition driven growth, because
or even 40% maybe acquisition driven growth if it's going to be short term or non-recurring.
Unless there are some companies that generate so much cash flow they're buying out of cash. So that is a rarefied animal, really, that you find. So I mean, for us, it would be, you'd like to see more organic growth. So where is your growth coming from? It's a good metric to look at, but it's definitely like you want to look at where the growth is coming from. And Aaron said you can actually have a situation where the company's not making any money and it still passes, really, right?
Yeah, so it's a great point.
It's you gotta. I think it's designed for companies that are balancing those two, right? But by the rule, you could see a company not making any money at all and just pass the rule.
For sure.
So it's a good summary. Thank you very much. You took us to school to start September. And now, Brett, we're going to do an interesting segment here. We're kind of doing the looking back at, kind of a stock battle that we did a couple years ago, I believe, on Greenlane and Xebec. Is that how we say it? Xebec, right? I believe it is.
I think so.
It starts with an X, so any word that starts with an X other than X-ray for me is just it's difficult. But so Xebec Absorption, where they were then and where they are today. When we reviewed them back then, it was pitting two against each other. Greenlane won the battle, but neither of them kind of won out as a buy or anything like that from our research. We had actually just completed our renewable energy or clean or green energy report at the time, and there was a couple other companies that beat them out. One of them was Polaris that we have under coverage, and it's gone on to produce gains over that period, whereas these two, I think I'm foreshadowing a little, that didn't make our criteria, have not posted those gains, and we'll see how they did relative to each other as well. But Brett, I'll let you go.
All right. I am going to go through a follow-up on the June 2021 stock for stock on Greenlane Renewables, symbol GRN on the TSX, as well as Xebec Adsorption, symbol XBC on the TSX. At the time, we wouldn't consider either a buy, but Greenlane was the better prospect of the two. Greenlane is a provider of biogas upgrading systems which produce clean, renewable natural gas from organic waste sources. It currently trades at a share price of 75 cents and a market cap of 115 million at a trailing price to shares of 1.8 times. Xebec designs, engineers, and manufactures products that are used for purification, separation, dehydration, and filtration systems for gases and compressed air systems. It currently trades at a share price of 77 cents with a market cap of 122 million and a trailing price to sales of 0.8 times. Both companies have fallen significantly in price over the past year, Greenlane by roughly 50% and Xebec by roughly 75%, leading to the question, has the drop in price made the companies appealing enough? First off, Greenlane. The company is failing still to produce net income or a consistent operating profit. However, the company has been able to consistently grow its revenue and gross profits. The most recent quarter, Q2 2022, had revenues of 18.1 million and a gross profit of 3.9 million, up 44% and 34% respectively from the previous year. The company has a current sales order backlog of 40.7 million and a sales pipeline of 900 million. And the sales pipeline is just what they've quoted for, but they might not necessarily take on for a contract or receive the contract. A recent highlight is an additional contract worth 13.5 million in South America, which was announced after the recent quarter. The high growth prospects are supported by a strong balance sheet with a cash position of 23.2 million and no debt. However, that cash position has been declining quarter over quarter. Overall, the company has made strong top-line growth since our last coverage, but is still failing to produce a profit, meaning it still does not meet our criteria. Moving to Xebec, it is seeing significant revenue growth, but is running a net loss and operating loss. For the most recent quarter, Q2 2022, revenue grew to 44.5 million from 32.7 million in the prior year, a 36% increase. While operating loss and net loss were 21.3 million and 23.4 million respectively. The company does have an order backlog of 270 million and as well as a net debt position of 37.8 million. Going forward, profitability should be able to improve as the unprofitable legacy renewable gas contracts have been fully written down, meaning that all the losses have been recognized in income. As well, the natural gas segment has seen some restructuring with the aim of achieving profitability. However, the company would still be at a net loss without the impact of the legacy contracts. Part of the company's transformation has allowed them to take on a $113 million contract with Summit Carbon Solutions for a carbon capture solution, which is expected to be delivered by the end of 2023. So until then, you will not see an increase in the profits. Comparing the two companies, Greenlane is still the clear winner, with no debt hindering its position and being closer to profitability. Xebec may see some light at the end of the tunnel by 2023 if it is able to successfully cut unprofitable segments and capitalize on the large carbon solution. As of now, neither of these companies would still meet our buy criteria.
Good job.
Yeah, no, it's a good review of those. One of the, like, outside of the fundamentals, one thing that, you know, when I look at these businesses, like as I understand, like the biogas used to produce renewable natural gas often comes from like sources like solid waste, landfills, anaerobic digesters, water resource recovery facilities, and livestock farms, food production, all of those sources. I'm just not sure it's I mean, it's good to capture that energy. It's good to use it into renewable natural gas. I'm just not sure it's the most efficient way that we have out there of producing, say, electricity, right? Or you know, if we're using gas or something. I just don't know if it's.
Well, Ryan, you remember we actually spoke with the CEO of Xebec.
Yeah,
I think
yeah,
it would have been
person.
around 2018, maybe possibly 2019 when we were at the LD Micro Conference in Los Angeles. And, you know, it was an interesting story back then. They were making improvements, moving towards profitability. And he had set a target, I think it was within a year or something of that, of the company being fully profitable. And based on the story that the company had at the time, it seemed very, very realistic. But one thing that I noted is that the cost of renewable diesel is that their cost was extremely high. So I wasn't sure how that was going to be in any way competitive. But in regardless of that, they've not even come close to hitting their targets of profitability.
And when we looked at the time, they weren't hitting their targets. That was the issue that we had, and we presented that to him, and he said, "Yeah, we got a little ahead of ourselves."
It was a beloved stock for a short time, though. I mean, it had great revenue
Mm-hmm.
growth. It had, great EBITDA growth.
And the brokerages, the boutique brokerages, were all over this with massive target prices, and but they were always over promising and under delivering. There's tremendous revenue growth here. They've had that kind of business book backlog that's always looked massive. But if you can never, I mean, we talk about this all the time. You can promise the world, or you can have great revenue growth. This company has had good revenue growth. Xebec, we're talking about, but never delivered on a bottom line. Eventually, you have nothing to fall back on, and the share price, plummets, and that's what happened in this case. And they just don't meet our initial criteria. I mean, Greenlane potentially, it hasn't fallen as much, but if that's your,
but it still lacks the cash flow, right? It still lacks the profitability. And I mean, I don't really care about a company racking up revenue and more revenue if they're not able to generate profitability on the bottom line. Like, one thing that bothers me about the public markets is that, I see the public markets as fundamentally being no different than the private markets. It's easier to raise money, and that money should be raised for growth. That's essentially the point. But what I don't like is when companies use the public markets to essentially fund their, ever increasing net losses that never seem
to keep the lights on and keep perpetuating, paying huge salaries to the C-suite, like paying huge salaries to the management teams, but never really having the discipline to make a profit. And likely because some of these quote unquote sexier stories have, at times in the market when renewable energy gets hot, for example, they have an easy time raising capital. And then they just go into another cycle where they continually lose, promise, and never deliver. There are companies in that segment right now that are making really good money. We have 2 or 3 of them under coverage, and they have done well over this period, as opposed to this business not doing so well. Probably not the sexiest companies out there. Like, we have a company that does water treatment that was in that report. A company, renewable energy company that's actually producing electricity in Latin America. We talked about that. These businesses have been, one of them pays a great dividend, another one. And the point is, there's an actual cash flow base there. Over this period, since we've seen these, the sector's been hot. These 2 companies have cratered in value. Those 2 companies have paid dividends and gone up. That's what we want to see in our portfolios. And that's why when we put together that report, those are our recommendations versus maybe the flavor of the day or what looked like the sexy story at the time. Because you had, in this case, like Xebec ran up to what, $11, $12. It's at 70 cents now, right? Like, that is a complete destruction of capital if you're investing based on the story and not minding the store, which is the cash flow in the business there. So I think it's a cautionary tale of, hot at that time. Is it going to be hot into the future? And that may make a good segue into my next segment here from the mailbag. Certainly a hot stock right now, but does it have the underlying fundamentals to drive the business? We get questions on resource companies all the time. Some of the time we don't answer them because there's nothing really to dig into. In this case, I'll go through this business quickly, not into too much depth, but I'll go through Patriot Battery Metals Inc. It's PMET on the TSX Venture, and just look at what they do and what has driven the share price, and is there any underlying fundamentals to justify that. So Patriot is a mineral exploration company focused on the acquisition development of mineral properties containing battery, base, and precious metals. The company's flagship asset, 100% owned Corvette property located basically in James Bay Corridor region of Quebec. Also, it has 2 gold prospects in Idaho. So there's no revenue here. It's an exploration business. You wouldn't expect to see some, but there's nothing really to analyze from a cash flow perspective. The net loss in the last quarter was $4.4 million. So we can look at the balance sheet as at June 30th, 2022, $8.8 million in the bank. The accumulated deficit on this business is about 16.6 million. It's been around since, I believe, 2007. It's done a rollback in its shares. Many of these businesses have that type of history. So what is driving the share price right now? Number one, good lithium drilling results at its drill program at the Corvette property. Number two, it's a hot market for lithium or battery metals, essentially, right now. Now, our take, we'd be very cautious. Shares have run up from the 54-cent range at the start of this year to $6.70 today, primarily on those positive, what look to be positive drill results. While the drill results are promising, positive drill results are a long way from delineating an actual resource that is worth building a long-term sustainable and profitable mine on. There are countless things that can derail a junior miner on that path, and we've seen it literally 1,000 times derailed. While this rise looks dizzying in the segment, in this segment, junior resource companies, the drops are often just as dizzying, if not worse. We prefer to stick to cash-producing businesses with growth, strong upside, but something to fall back on in terms of fundamentals when the tide eventually goes out. And in this segment, it always does. At this point, Patriot would not make our initial criteria. It's pure speculation, and we would look elsewhere if you want tremendous gains with some downside protection.
Perfect.
Good.
Not much to say.
Yeah, there's really not much. Honestly, like, you could tell this story. I mean, maybe Patriot does find the next greatest lithium deposit. You'd be better off going to a geologist, and even then they would likely tell you that it's very difficult to go from good drill results to a very profitable mine. And, this company has gone up on the back of what looks like very good drill results. At least they're publishing, their good drill results. Now, whether that translates into any cash flow at any point in the next decade remains to be seen. But right now, you're paying, a pretty penny for a business that really doesn't have any underlying cash flow. And it's, very speculative at this stage.
Yep.
Okay, let's move on to our next segment. Is that Aaron here?
Yes, I think I'm going to talk about Nvidia here. So we received a question from one of our listeners regarding Nvidia. It's a company that we've covered or we've followed quite closely in the past. We never actually had an official recommendation on it, but one of the best performing tech companies over the past several years, until recently at least. Nvidia Corporation, the symbol is NVDA on the NASDAQ exchange. It's trading right now for about $137, and it's a $340 billion market cap company. Nvidia is the world's top designer and manufacturer of GPUs, or graphic processor units. And these GPUs are used in high-end PC gaming devices. They're used in data centers and also in automotive systems. In recent years, the company's GPU technology has also been applied to the development of complex artificial intelligence systems, including autonomous driving. A little bit of background. Nvidia was the top performing tech stock for the period leading up to one of the top performing tech stocks in the period leading up to November 2021. Since then, the stock price has come down hard, as has been the case with many of the company's high growth technology peers. Nvidia's stock price is down 60% from its 52-week highs back last November, and the stock is also down 24% since it released its Q2 results about 2 weeks ago. We took a look at the quarter, and at face value, the quarter did look pretty ugly. Revenue was $6.7 billion, which was down 19% compared to the most recent quarter and up only 3% year over year. Operating income was down 67% and 51% respectively compared to Q1 of this year and Q2 of last year. And non-GAAP earnings per share were 51 cents, down 63% from Q1 of this year and down 51% from the same quarter last year. So these are some of the weakest numbers that I've seen from Nvidia in many years. But the decline in growth was not necessarily a big surprise to the market. Analysts were expecting about 52 cents in earnings per share. So the company's reported figure only missed expectations by about a penny. Q2 revenue was more or less in line with analyst expectations. Nvidia did provide guidance for Q3. The company's expecting revenue in the range of $5.9 billion. And this would equate to a decline of 12% sequentially from the most recent quarter, Q2, and 17% decline year over year. When we look at the numbers by segment, we can see that Nvidia's two most important end markets are data centers, which made up 57% of revenue, and gaming, which is 30% of revenue. It's really gaming where the company is experiencing weakness. Gaming revenue was down 33% in the second quarter to about $2 billion. Data centers, on the other hand, continue to perform very well, with growth of 61% to $3.8 billion for the quarter. But the weakness in gaming is expected to persist into Q3, and this is why revenue for that period is expected to decline. Another thing that we need to consider with Nvidia is the situation in China. There are two issues with China. One is the government's zero COVID policy, which has caused widespread disruptions in the economy, in China's economy this year. And this has impacted the financial performance of many semiconductor and computer chip companies. Another is China's relationship with Russia in reference to the current Western sanctions against Russia. On August 31st, Nvidia filed an 8K form with the SEC, and they disclosed that they had received notice from the US government that they needed to curb sales of some products which were suspected of reaching Russia through China. Other chip companies also received the same notice. It's unknown what financial impact this specific notice is going to have on Nvidia and their financial performance. But China is an important market for Nvidia. Last year, the company estimated about $7 billion or 26% of Nvidia's revenue was connected to China. So in conclusion, there is a lot that I like about Nvidia in the long term. Its innovation in the GPU space is really unparalleled. And this has allowed the company to capture 80% of the share of the discrete GPU market. This is critical hardware that is used in AI systems, including autonomous driving and also data centers. And we're very impressed to see that the company is continuing to grow its data center business as well. So when we look long term, when we're looking 3 to 5 plus years in the future, all of the growth drivers of this company remain well intact. In the near term, however, there are uncertainties, and the guidance for Q3 indicates that that the financial weakness is not completely behind the company. So right now, I would classify Nvidia as a short-term hold, long-term buy. For people looking 3 to 5 years in the future, I continue to see this company as one of the top performers in the tech market. You could start building up a position now potentially, but I'd probably start off with a quarter, half position, and then potentially add more down the road as the company comes out with more quarters. In the short term, looking the next 2 to 6 quarters, I'd say there's a lot of uncertainty. And until we start to see the revenues and the earnings grow again, or at least some of these uncertainties behind the company, I would be a little reticent about taking a full position in the stock right now.
Yeah, it's an excellent summary. It definitely was Nvidia a high flyer and has seen that significant reduction. It shows you can't pay anything in terms of multiple for a stock, even a really quality business like Nvidia.
Yeah, and I think Nvidia's multiple, they'd gotten up around 70, 80 times at its very peak. Now I think it's come down to probably about 40 times. Brett and I were actually talking
multiple now.
40 times, yeah. 45, yeah, which is still premium, particularly considering that, a lot of
negative growth, right?
Exactly, yeah. Brett is actually chatting with Brett. He's, fairly well versed on some of the semiconductor stocks, so he had some insights into what he thought was going on with Nvidia and some of the competitors.
Yeah, so for the uncertainties Aaron was talking about, there's quite a few actually for Nvidia in particular. First off, there's going to be no more GPU crypto mining. Ethereum's on the way out of proof of work, which is what practically all the GPU mining is going on in about 2 weeks, mid-September. And with that happening, a lot of those gaming sales, even though they list them under gaming, a lot of them were going to cryptocurrency. They've actually been sued for this before during, I think, 2018, 2019. I forget which one was the fiscal year. But even if they say it's gaming, it not necessarily is, even to their best of their knowledge. They might not be a fault. I'm not saying they're necessarily going to get sued. It's just something you need to be aware of. As well, they pretty much got a free pass with their 3000 series because there was such limited supply of GPUs during the pandemic. And now they're coming into the first non-pandemic year. GPUs, they have a massive backlog of GPU supplies. So until about 6 months ago, impossible to get one for a regular consumer unless you're paying upwards of 2 or 3 times the retail price. And now they're about a quarter of the price they were then. So they're half the retail price. You'll see a 3090 for $1,000 now. They were $4,000 6 months ago. So you're
Crazy.
Yeah, it was absolutely insane, and they were capitalizing on it. So they were ramping up their supply, and now they have a massive backlog. And this is a rumor, so don't take it with a massive grain of salt. But there's been a rumor that they've actually pushed back their 40 series for the consumer cards back about a quarter. So it was expected to be about September, October for this, and now they're looking towards the end of the year for their release, which is a massive change when they have to push through all these 30 supply. Their partners are going to be losing money, and also those contracts will generally have some sort of a rebate on them. So if like Gigabyte, MSI, those types of players, if they can't sell for the respected price that they bought for, they actually get money back from Nvidia, which can hurt them obviously. And then the other thing which Aaron was mentioning was the data center cards which are blocked from China. I'm not sure on the specific cards, but those are essentially anything past the consumer card. So those are their A series cards, formerly their Tesla series, and that's any of their data center cards, any of their AI cards. Those are prevalent in China as well, which is they are facing a lot in these next few quarters, to say the least. Like Aaron said, it's a hold, and I would really wait more than anything. I think I'm being more pessimistic than him. There is definitely long-term growth, but the short terms I could see some big hits to their bottom line.
Wait till some of that sorts itself out, or we have more clarity on what's going to happen, and then
That's exactly what I'm getting
points. Great point.
Yeah, it's certainly a good idea, and you're not buying it at a deep discount or anything like that. Even like many people will look, and this is just a general. You see a 60% decline in a high quality business with one that's been a high quality business, and assume that it's on a deep discount. With the elevated, euphoric valuations we saw in 2021, like a 50-60% decline has not reduced every company to just being like in bargain basement levels. Like there's some that need to be down 80%. I know it sounds shocking.
We've seen companies that are down almost 80% or 80%, and they're still overvalued.
In that range, yeah. Like it's and you're still, then you look at it and say, oh, this is still at 100 times earnings. The valuation that they were trading at, and I can't stress enough of how high or how much the valuations got out of hand in 2021.
Yeah, 100 times earnings, or still 20 times, 30 times, 40 times sales. You had
100 times sales on businesses then too.
Yeah.
Like not just earnings, right? Like it's got to that, and it just it's a company has to just continue to grow at hundreds of % every quarter just to
demand
grow
that multiple.
those valuations.
Yeah.
Okay, well, that'll do our show for this week. We're gonna look in the fall to have some interviews going for on this show. We're looking to book those over the next couple of weeks. So, sometime in the next 2 months, we'll get those on the show, and definitely it'll bring a different perspective when we interview from businesses. Smash that subscribe button. If you're on YouTube, if you're just listening to this as a podcast, go to iTunes, rate and review and subscribe, and everybody will be happy that I said that, right? So anyways, do that, keep doing that, rate us, and we'll bring you the content every week. Thank you very much, and I wish you all out there profitable investing.
Great. Thanks a lot, everyone.
Thanks, everyone.
Thank you.